Hello, everybody. Luke Gromen, FFTT. Hope you are well. Hope everyone is having a good week so far. Big Super Bowl week. I don't know who you got, Chiefs or 49ers. Should be a good game, though, so I'm excited to see it on Sunday. As always, thanks for submitting questions. Really appreciate it. Very helpful. Great way to help hone, refine, change my thought process. So thank you for the question submissions. And with that, let's jump right in and touch on a few of them. From JRM, where, if anywhere, does the chance of outright deflation inform your macro viewpoint in the short term versus the long term? Short term, openly admit and acknowledge that you could have a brief period of deflation. It would probably have to be from some sort of very severe external shock. Beyond the short term, though, the U.S. debt situation at 120% of GDP, and again, I pick on the U.S. because the U.S. is a reserve currency issuer, dollar's the center of the system. Beyond the short term, U.S. debt of 120% of GDP, U.S. deficit of 7 to 8% of GDP with unemployment still 3 and change. Net international investment position of the U.S. at negative 65%. All of those things combined when overlaid with foreigners who have borrowed $13 trillion in U.S. dollar denominated debt means that any sustained deflation will lead to a Treasury market dysfunction. If it's not ameliorated immediately with more dollar liquidity, that will lead to Treasury auction failures. I don't think it's going to happen. I'm simply describing the mechanics of what would happen were the Fed and Treasury to stand aside in case of deflation. And critically, we know multiple times now, September 19, March 2020, September 2022, March 2023, October 2023, November 2023. We know that Treasury market dysfunction will not be abided by the Fed and or Treasury. And that is ultimately good on a secular basis for assets that benefit from currency debasement. Stocks, real estate, Bitcoin, gold. And critically, even if for some freak of nature, Fed and Treasury did stand aside and let an auction fail, again, it ain't going to happen. But let's be hypothetical. I think you'd still see currency debasement in assets like gold in particular, Bitcoin as well, self-custodied, do well. So the threat of deflation does inform my macro view, both in the short term in terms of risk management of, look, it could happen. And so that's why I repeatedly say you want to be unlevered. I have a pretty strong conviction about the end game. The path from here to there can go a lot of different ways. So in the short run, you could have a brief period of deflation. However, it really more informs my macro view from a margin of safety standpoint, or even from sort of, I like to think about the world as like my back up against the wall. Okay, back up against a wall. Now I know nothing's going to get me from behind. I can see everything in front of me. Now what? The back up against the wall view here is, okay, we could have a little bit of deflation. Sure, it is conceivable. That's the back up against the wall view. Make sure a little bit of deflation doesn't take me out on my shield. And then if that's the case, we have pretty high conviction, very high conviction, that Treasury market dysfunction will not be abided for very long. And then we can go forward from there. From Gronky, at what point does Yellen or Powell need to weaken the dollar to provide liquidity for the Treasury bond market? How that March cut is off the table and the small banks and commercial real estate don't matter. Let's see. So I think watching what we're seeing in CRE, it's maybe starting to get a little worse again. Obviously, NYCB has traded not so hot the last few days, to put it mildly. Ultimately, dollar liquidity, I think, has to be added soon. True interest expense are back, which is entitlement pay-goes plus Treasury spending, it's back to 100% of receipts in calendar fourth quarter, fiscal first quarter. So what that means in plain English is if you don't get it soon, we're going to go right back to that 3Q23 regime of dollar up, gold up, Treasury yields up, everything else down, wash, rinse, repeat. until we get enough Treasury dysfunction that the authorities have to step in. And enough is, for example, we saw that 5 basis point tail on that, I believe it was a 30-year auction back in early November. That was never supposed to be able to happen, yet it happened. So at any rate, ultimately, the fiscal situation being where it is, I think mandates that we're going to get more dollar liquidity soon. Don't know what the catalyst is. Let's watch, as I like to say. From Brusque, looks like it's all an anti-dollar trade now, Luke. Down to the 1-minute chart and including treasuries as a risk-on trade rather than risk-off. Has the whole world collapsed down to the FFTT view? In my opinion, it's more mechanics that are driving this. My sense, and I could be wrong about this, my sense, though, is that most investors have not accepted that the U.S. is back in fiscal dominance again. Nor have they accepted the implication, the second derivative implication of that, which is that the Fed's shadow third mandate of Treasury market functioning will dominate, again, the mandates of the other two traditional dual mandates of employment and low inflation. The interesting thing, though, is I think these sort of debasement trades, the core trades expressions of this, GLD over TLT, Bitcoin over TLT, S&P 500 over TLT, the way these look on longer-term charts suggests that Mr. Market is already playing by these fiscal dominance rules and has been really for the last couple years, even as most investors, I think, are still playing by the old rules, and sort of a nod to a famous Bob Farrell quote from the famous Merrill Lynch strategist. So I don't know if the world's collapsed to that view or not, but I think mechanically this dynamic that once the dollar gets too strong, everything else goes down, other than gold, really. We're seeing that more frequently. And critically, where we are in the fiscal update after the TBAC report last week, we're getting close to a critical threshold again, almost back where we were in August of last year. So we're going to keep a very close eye. From Henry, what does it tell you now that interest payments exceed national defense spending? And that's gross interest spending in the latest Treasury Borrowing Advisory Committee report. Let me go back in time. So back in, I believe it was the second quarter of 2016, we wrote a report for clients. We first looked at this as what we call the big three expenditures. So the biggest three things that the U.S. government spent money on that could not be cut. And they were entitlements, Social Security and Health and Human Services, so Medicare, Medicaid, defense, and Treasury spending. And back then, Treasury spending was actually below defense. Very quaint. At any rate, we called those the big three: entitlements, defense, interest. And when you totaled those big three up, they were about 89% of tax receipts in the second quarter of 2016. In this report, we ran through some different scenarios of where they could possibly go based on rate hikes, based on recession, so on and so forth. And what we guesstimated in that report was that by 2020, maybe mid-2020, late 2020, the big three would hit 100% of receipts, and that could potentially be problematic. Reality is that the big three hit 100% by the third quarter of 2018, less than 2 years later. Ultimately, the resulting crowding out, dollar up, risk off, contributed certainly, if not forced, the Fed to stop hiking in 4Q18 and then cut in 2019. And so fast forward to today, where are we? The big three are now 125% of receipts and rising. They're going to rise a lot this year because average Treasury interest rate right now coming into the year is about 3.1%. I think it easily closes the year. You've got $9 trillion to refinance this year. You're probably looking at 3.5% average rate minimum exiting this year unless rates are slashed. And so what this tells us then, at 125%, with unemployment at 3.5% only, or 3.7, wherever it is, it's still near the 60-year lows. It tells us that barring, you got to get a productivity miracle, or you're going to have to slash spending on DOD or entitlements. Both probably politically impossible, certainly in an election year. You're going to have to slash rates, or you're going to have to devalue the dollar, or effectively do some sort of new massive dollar liquidity. And in our view, more liquidity is the only politically and economically palatable answer. Ultimately, that informs our macro view and our heavy gold and Bitcoin positions, but it also informs our heavy short-term Treasury position, which we hold, all of which unlevered. Because one thing we should have learned from this, what is effectively the U.S. government crowding out global dollar markets, global rates markets, is that volatility is likely to remain high in global rates and global FX, which means it'll likely remain high in global risk assets as well. And again, we feel pretty strongly about the most likely end game, but the path, we need to be prepared for high degree of volatility, not just in the classical stuff that we've all seen it in for a long time, stocks, commodities, but also in things that are relatively new. Rates volatility, G7 rate volatility, G7 FX volatility. And then the final question is, WR, at what level do interest payments on the U.S. debt start pushing the rate of inflation higher? The broad answer to that, in my view, is when the U.S. fiscal situation starts forcing the Fed and or Treasury to intervene in the Treasury market one way or another in order to keep it functioning. And in that case, my answer would be September 2019, repo rate spike. That was ultimately, there were some regulatory issues to be sure that were balance sheet constraining, but the bottom line, it was too much Treasury supply, not enough demand, not enough balance sheet. Yes, balance sheet capacity was restrained by regulatory rules. However, repo went from 1 or 2, wherever it was, percent to 8 to 10% overnight. The Fed came in within 48 hours with more liquidity. That's when the inflation, I think, the fiscal situation ultimately started. That's where I date it to. Started really driving inflation. You can make an argument that it started in 4Q18 when it forced the Fed to stop raising rates, as I noted back a few moments ago. Certainly there's a case to be made for that. So with that, I'm going to finish up for tonight. As always, thank you very much for joining me. Enjoyed it. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, and how it's either supporting, confirming, or refuting a way we had been thinking about the world before having read and highlighted that. So thank you again very much. Enjoy the rest of your week, everybody, and we will talk with you soon. Take care, everyone.